Hey, Mike Kinnett here from Prostatis. If you're new to the channel, welcome. We simplify retirement by helping you protect your savings, reduce your taxes, and make smarter financial decisions with confidence. Now, today's video is all about risk tolerance, what it is, how to find yours, and how it changes as you approach retirement. Most people think of risk as how much risk can I take and handle before the market drops, but it's actually a lot more than that. Risk tolerance is about how much volatility and potential loss you're willing and able to accept to reach your financial goals. Now, here's a simple way to think about it. If you're in 30s or 40s, retirement is 20, 30, 40 years away. You've got time on your side. The runway length is long. You might be more comfortable with higher risk investments, things like growth stocks, emerging markets, or even tech-heavy ETFs that have more upside but just much more volatilities. But you know what? If you're in your 60s, already retired, or living off your portfolio, that same approach can be devastating. A sharp drop in the market doesn't just hurt your balance, it can permanently damage your income plan if you're drawing funds at the wrong time. That's why understanding risk tolerance isn't just about attitude, it's about timing, income, and goals. Goals dictate the amount of risk you should take. So what does high risk actually look like? High risk assets might include speculative individual stocks, early stage tech companies or biotech firms that swing widely on earnings and news. It could also include aggressive sector ETFs or cryptocurrencies. These are assets with a potential for huge growth, but also huge losses. Now, on the other hand, low risk strategies might involve fixed index annuities, bonds, dividend paying blue chip stocks. Think companies like Procter & Gamble, Johnson & Johnson, utility companies. They're not flashy, they're not sexy, but you know what? They're steady. The tortoise wins the race. That's why we often use tools just like this to help our clients build predictable income streams during retirement. It's actually amazing how many people come in and sit down with us and we look at what their portfolio says, and on the front of their statement it says, they're growth oriented, and then we ask them, you're growth oriented, are you comfortable with the growth oriented approach? And they say, sure, we could absolutely tolerate growth. And so then we look at it and say, what happens on a growth portfolio? That means you're willing to risk a 40% loss. So your $1 million on a Tuesday drops to $600,000. How do you feel? And inevitably, when we say that, when we show them what a high risk, a high growth oriented portfolio looks like, that they have that 40% chance of drop, because we know on average, every 7 years, the market drops 40%. And yes, I get it. It's going to come back. I don't know if it's going to be a V-shaped recovery. Is it going to be one of those U-shaped recoveries? Is it going to take, 10 years? Is it going to take 3 years? Is it 13 years like it was from 2000 to 2013? I don't know when the recovery is coming. But when you sit down and look at your $1 million portfolio, drop to 600,000, and you're trying to figure out how my income is going to survive that, yeah, it changes your outlook, and every single person I've ever sat down with always has a reconsideration on how much risk they should actually take. Our perspective, you always take the least amount of risk necessary to accomplish your goals. Quite frankly, if you can accomplish your goals, exceed your income needs, exceed inflation, and you can own nothing but CDs, why would you risk 1 penny in the stock market? Why would you have any exposure to risk at all if you don't need it? Take the least amount of risk necessary to accomplish your goals. We also see risk tolerance shifts during big life events, retirement, a spouse passing, market downturns, or even when adult children become financially independent. That's why we don't just set it and forget it. Risk should always align with your current life stage. They should always be based upon your goals. At Prostatis, we often start our conversations by asking, what are your real goals? If you tell us it's to never run out of money, we ask, what's the least amount of risk we need in order to get you there? It's not about chasing the most significant return. It's about creating the most reliable plan. Remember, the dog wags the tail does not wag the dog. The plan, the goals have to control the risk. The risk does not result in a goal. So if you're unsure how much risk your current plan is taking, or whether that risk matches your income needs, your taxes and legacy goals, let's have a conversation. Download our free Savvy Investor Retirement Summary or schedule a discovery call with our team today. And if this helped clarify how risk fits into your retirement, give us a like, subscribe, and leave your questions in the comments sections. We are here to help you.